So there's an awful lot of talk about passive these days, and a lot of people saying, that's the way to go, that's where the direction is.
Yep.
Is that right? What is the argument on the other side?
Well, the thing to know about Russell Investments is we're agnostic. We're all about delivering solutions to the clients that can come from anywhere in the world, any type of manager, any style, and it can be in factors. We're a pioneer in the factor investing and systematic investing overall, but it can be in passive, it can be in active, but we are believers in active management. We have been for a long time. We've added tremendous value picking some of the best managers in the world. And so active is not dead, it's going through a rebirth. And the metamorphosis that has to occur is to be focused on the outcomes and the solutions at the client level. So we're going through a massive pivot in the industry, not just around passive versus active or fee compression. It's all about getting the needs of the clients met. And so this has largely been an institutional asset management industry. The pivot is to the individual, and the pivot is also to outcomes versus components of a solution.
Part of the problem, I think, going into the active management industry was rising tides were lifting all boats. You had equities rising, bond rising. It was hard to justify the fee for really picking a stock when you could just go into an index fund and you knew that it would, well, usually go up. Now with all the volatility and the uncertainty, is this your time to shine?
Right. Well, I would say our time to shine is in any market environment, again, because we're customizing around individual outcomes. But having said that, I think your key point is that active management does have a place in the ecosystem of the industry. Doesn't need to be the dominant part of the industry, and in fact, it may not be. But it does have an important critical role to play in the industry. And with this heightened degree of geopolitical uncertainty, inefficiencies do provide opportunity for active management. And that's where you are seeing many managers start to add value in dislocations in the market. But the old norms aren't going to work as much as they did historically, and hugging benchmarks and being so siloed and compartmentalized in how you deliver alpha creation to your clients is under scrutiny, and rightly so, So
the general trend has been, I think, sort of a movement toward passive flows. We put a chart up here, actually, on my terminal that indicates it's been up and down, but overall, passive has been gaining. You say it could become the dominant even. As you're picking horses for courses, as it were, how do you pick? Because you have a bigger challenge as active because your fees are higher if you're an active manager.
Absolutely. So what we do is look for the most inefficient asset classes in the world and the best managers that we can possibly partner with in order to deliver that value to our clients. But it's not static, right? We are a dynamic manager. We're an investment-centric, client-centric firm. And so from that standpoint, the most important thing to us, whether it be in private, whether it be in alternatives, is that we deliver value in sustainable forms of alpha creation. And so, we are continuing. We recently reorganized our entire firm, orienting around outcomes, again, agnostic to the types of managers, the types of asset classes, the types of geographic regions, making sure that we can deliver in various different environments.
You talked about inefficient markets. I know it's way more complicated than this, but for example, you could say you go passive in large cap because you can outperform, and you go active in small caps where you can really find those inefficiencies. Is it more complicated than that, or is that something that you're working on as well?
Another part of the ecosystem that's changing pretty rapidly is that I don't think that slicing things by cap sizes is necessarily a sustainable way to differentiate yourself into the future. And so we can find large cap ideas, large cap concentrated managers. It's more about the process and the insight, irrespective of the geographic region or the cap size, but trying to outperform static passive indices. That is what is a dying breed to have long-term sustainable outperformance.
I find that really interesting because there's a tendency to think with a large cap, there are more people analyzing and there's more data out there, and so the inefficiencies are harder to find. Where do you find the inefficiencies, the market inefficiencies that an active manager can take advantage of in the larger corporations?
Yeah, well, again, these are insights. Just because money is following doesn't mean that it has an original point of view. And you see that, U Chicago. One of my sons is going to University of Chicago, and one would say that active management should have been dead long ago, and it's not. And a lot of behavioral economists have shed light on the fact that not all individuals and not all market participants act rationally to the same set of news. So again, in a period of heightened uncertainty, our primary focus is on making sure that people understand their long-term strategic goals and objectives, and making sure you have both a tactical, dynamic allocation that adjusts to the market environments that we're in. But by far, the most important thing is to understand the liability that you're matching. And that to us is the other pivotal thing to understand. We have an $80 trillion retirement crisis today. Yep. It will grow to $400 trillion if we do nothing differently. So let's assume that we continue having, generally speaking, upward markets. We continue doing okay on behalf of the clients. We continue driving costs down. We will still have a $400 trillion problem that has to be solved, and our industry is critically important to solving that problem. And it's not by chasing large cap versus small. It's about making sure that we're delivering for the end client.